two economic titans, one shared enemy. For the last 5 years, the US and the Eurozone have fought a brutal war against inflation. It was a crisis that redefined global finance, crushed consumer purchasing power, and forced central banks into the most aggressive tightening cycle in history. Today, in late 2025, the worst is over. The massive peaks of 2022 are behind us, but the battle isn't won and the scars remain visible. While the trajectory looks similar on a distant chart, the reality on the ground was fundamentally different. The drivers, the pain points, and the current risks are not the same. To understand the global economy right now, you have to understand why American inflation and European inflation are distant cousins, not identical twins. This is the definitive breakdown of the Atlantic divide. Welcome to the ultimate comparison of Eurozone versus US inflation. Before the divergence, there was unity in chaos. The initial spark for both regions was identical: the violent reopening of the world economy post-lockdown. Global supply chains, brittle from neglect, snapped under unprecedented demand for physical goods. You couldn't get microchips, lumber, or cars. This supply shock was universal. It didn't matter if you were in Berlin or Boston. The cost of moving things across oceans skyrocketed, and those costs were passed to you. Simultaneously, both sides saw massive monetary expansion. Central banks kept rates at zero for too long, pouring liquidity into a constrained system. Throughout 2021, the narrative was transitory. Policymakers on both continents assured us these supply bottlenecks would resolve quickly. They were wrong. By early 2022, the synchronized dance ended. A massive geopolitical shock was about to tear the inflationary narratives apart. February 2022 changed everything for Europe. The invasion of Ukraine wasn't just a geopolitical tragedy, it was an economic heart attack for the Eurozone. The Eurozone's heavy reliance on cheap Russian energy was exposed instantly. Natural gas prices didn't just rise, they went parabolic, threatening industrial collapse. This was a pure supply-side shock. It wasn't Europeans buying too much. It was the fundamental input cost of their entire economy exploding overnight. Inflation in Europe morphed into an existential crisis. Governments had to spend billions subsidizing energy bills just to keep the lights on and people warm. While U.S. energy prices rose, it was nothing compared to Europe. The U.S. is an energy producer. The Eurozone is a net energy importer. That difference was critical. Europe successfully pivoted away from Russian gas by 2024, but the structural cost of energy in Europe remains permanently higher than before the crisis. Across the Atlantic, the primary driver was different. Yes, supply chains were snarled, but American inflation was supercharged by unprecedented demand. The U.S. fiscal response to the pandemic dwarfed Europe. Trillions of dollars were injected directly into household bank accounts, creating a massive buffer of excess savings. When the economy reopened, Americans had firepower. They spent aggressively, first on goods, and then in a massive wave on services and experiences. This was demand-pull inflation, too much money chasing too few goods. The U.S. economy ran hot, growing robustly even as prices soared. This intense demand ignited the labor market. A severe worker shortage led to rapid wage growth, creating a feedback loop that Europe didn't experience to the same degree. So, by peak inflation in 2022, the distinction was clear. Europe was suffering from an energy supply crisis. America was suffering from a consumption party hangover. Faced with overheating demand, the Federal Reserve realized in 2022 that they were behind the curve. Their response was historic blunt force trauma. The Fed embarked on the most aggressive rate hiking cycle in 4 decades. They didn't just tap the brakes, they slammed them to the floor. Chairman Powell was explicit. The goal was to crush demand, cool the labor market, and ensure high inflation didn't become entrenched in the American psyche. The impact was felt immediately in interest-sensitive sectors like housing and tech. The era of free money ended violently in the United States. It took time, but the medicine worked. By suffocating credit and making borrowing expensive, the Fed managed to put a lid on the demand-driven pressures. Even as inflation cooled in 2024, the Fed maintained a higher-for-longer stance, terrified of declaring victory too soon and seeing inflation resurge. The European Central Bank faced a much more agonizing dilemma. They had to fight inflation that they didn't cause with demand tools. Hiking rates to fight energy supply inflation is inefficient. It doesn't produce more gas. It just crushes the economy enough so people can't afford to buy anything else. The Eurozone skirted with stagflation, high prices combined with stagnant growth. The ECB had to tighten policy while the economy was already flatlining. They also faced the fragmentation risk. Hiking rates too fast could blow up bond yields in highly indebted countries like Italy, causing a new debt crisis. Consequently, the ECB started hiking later than the Fed and stopped at a lower terminal rate. They simply couldn't afford to be as aggressive as the Americans. Their approach was cautious, data-dependent, and painfully slow, reflecting the fragility of an economy dealing with a war on its border. Throughout 2023 and 2024, the global fever broke. Supply chains normalized, shipping costs crashed, and energy prices stabilized from their panic peaks. The Eurozone saw a rapid fall in headline inflation as energy prices retraced. Because energy was such a massive driver on the way up, its normalization caused a fast drop on the way down. U.S. inflation cooled too, but the descent was bumpier. The demand-side pressures and a resilient consumer meant the U.S. didn't get the same free lunch from falling energy costs. By 2024, both regions faced the same problem. Goods inflation was dead, but services inflation, restaurants, insurance, healthcare, remained stubbornly high. The divergence in cooling was about resilience. The U.S. economy kept surprising to the upside, keeping price pressures simmering, while the Eurozone economy stagnated, cooling prices through weakness. Which brings us to today. The dramatic peaks are history. Now we are in the grinding phase of the last mile back to target. Let's look at the scoreboard right now in late 2025. Where do the headline consumer price index numbers stand? In the United States, headline inflation has settled into a range just above the Fed's target, hovering around 2.4% to 2.5% year-over-year. In the Eurozone, headline inflation has actually dipped slightly below the ECB's 2% target in recent months, sitting around 1.9%. On the surface, Europe seems to have won. Their headline number is lower, but headline numbers are notoriously deceiving, masked by volatile energy and food prices. Europe's lower headline number is largely due to energy dragging the index down after the massive spikes of previous years. It's a mathematical base effect. To understand the true underlying inflationary pressure, we have to strip out the noise and look at the core data. That's where the real story of 2025 lies. Core inflation is what central bankers actually lose sleep over. It removes volatile food and energy to show the sticky, underlying trend of price increases. In the U.S., core inflation remains uncomfortably sticky, stuck near 2.8%. It has flatlined here for much of 2025, refusing to drop further. The Eurozone core is lower, around 2.3%, and showing a clearer downward trend than the U.S., reflecting a weaker overall economy. Why the difference? The composition of their core buckets matters. The U.S. number is heavily skewed by housing data, which lags real-time rents. If you look at supercore inflation, services excluding housing, the US is still running hotter than Europe, driven by consumer demand for experiences and travel. The takeaway for late 2025: US underlying inflation is stuck above target due to economic strength. Eurozone underlying inflation is drifting down due to economic weakness. The single biggest engine sustaining core inflation difference right now is the labor market. The Atlantic divide here is massive. The US labor market has remained shockingly resilient. Even in late 2025, unemployment is low, and wage growth is running hot, fueling consumer spending power. While not a 1970s-style spiral, U.S. service sector workers have enough bargaining power to keep wages rising, forcing companies to keep prices elevated. In the Eurozone, workers lost significant purchasing power during the inflation peak. They are now trying to catch up through collective bargaining, but it's a slow process. Europe faces structural rigidities. It's harder to hire and fire. This makes their labor market less dynamic, preventing the kind of rapid wage acceleration seen in the U.S. In short, American paychecks are still supporting inflation. European paychecks are still recovering from it. We cannot ignore the idiosyncrasies of how inflation is calculated, specifically housing. This is the biggest technical distortion in the comparison. In the U.S. Consumer Price Index, shelter accounts for roughly a third of the entire basket. It is the single biggest component. U.S. shelter data is notoriously lagging. It reflects leases signed a year ago. So, even though real-time U.S. rents cooled in 2024, the official CPI is still registering high housing inflation in 2025. The Eurozone's HICP calculation gives much less weight to owner-occupied housing costs. It's also a fragmented market. Rents in Dublin behave differently than rents in Athens. If you strip out the lagging shelter data from the U.S. numbers, American inflation looks much closer to the European level. This technicality means the Fed is fighting ghost inflation from past housing booms, while the ECB is looking at a cleaner, albeit weaker, picture. Inflation isn't just about central banks. It's about governments spending money. In 2025, fiscal policy is pushing these two regions further apart. The U.S. is running massive fiscal deficits at a time of peace and economic growth. The government is pumping trillions into the economy, effectively fighting the Fed's efforts to cool it down. This fiscal dominance keeps a floor under U.S. demand. It's hard for inflation to drop back to 2% when Uncle Sam is spending like a drunken sailor. The Eurozone is the opposite. In 2024 and 2025, the EU reinstated its strict fiscal rules, forcing member states to cut deficits and reduce debt. This shift toward austerity in Europe is a headwind for growth and inflation. Governments are taxing more and spending less, cooling aggregate demand. The U.S. government is still pressing the inflationary gas pedal. Eurozone governments are pressing the deflationary brake. The currency market acts as the transmission mechanism between these diverging economies. The euro-dollar exchange rate is crucial here. Because the U.S. economy is stronger and Fed rates are higher, the U.S. dollar has remained exceptionally strong against the euro throughout 2025. A strong dollar is a deflationary force for the U.S. It makes imported goods, from Chinese electronics to Italian wine, cheaper for American consumers. Conversely, a weaker euro is inflationary for Europe. Since global commodities like oil and copper are priced in dollars, a weak euro makes vital imports more expensive. The ECB hates a weak euro. It undermines their fight against inflation. This limits how much they can cut interest rates ahead of the Federal Reserve. It's a tug-of-war. The U.S. imports deflation through its currency strength. The Eurozone imports inflation through its currency weakness. Stepping back from the immediate data, This inflation saga has highlighted deep structural differences in how these two economies handle shock. The U.S. economy demonstrated incredible dynamism. Capital reallocated fast, workers moved industries, and businesses adapted to new pricing realities quickly. This flexibility led to a productivity rebound in the U.S. in 2025, which helps absorb higher wages without causing inflation. Europe's productivity growth remains sluggish. Europe relies heavily on bank lending, which dried up quickly when rates rose. The U.S. relies more on capital markets, which adjusted prices but kept credit flowing to good ideas. The Eurozone is also not a single country. A single monetary policy has to fit 20 different economies, some overheating, some freezing. It's an inherently inefficient system. The U.S. economy absorbed the inflation shock and bounced back. The Eurozone economy absorbed the shock and cracked. Despite their differences, both central banks face the same grueling challenge in late 2025. The last mile problem. Getting from 3% to 2% is proving harder than getting from 10% to 3%. The remaining inflation is the stickiest kind: services, wages, insurance. These prices don't adjust quickly to interest rate hikes. There's also the psychology. After years of high inflation, businesses got comfortable raising prices, and consumers got used to accepting them. Breaking that mindset takes time. This last-mile stickiness is why both the Fed and the ECB are hesitant to declare "mission accomplished" and slash interest rates back to zero. There is a growing debate in late 2025. Is the 2% target even realistic anymore in a world of deglobalization and green energy transitions? They won't admit it publicly, but both might eventually have to tolerate slightly higher structural inflation than they did in the pre-pandemic decade. Looking ahead to 2026, the risks facing the two regions are diametrically opposed. The Eurozone's primary risk is deflationary stagnation. Having tightened policy into a supply shock, the ECB risks overcorrecting. They might crush demand so effectively that inflation crashes below 2%, leading to Japan-style stagnation. The German industrial engine is sputtering due to high energy costs and Chinese competition. Without Germany firing, the whole Eurozone drags. If growth stalls completely, the massive debt piles in Italy and France become unsustainable again, threatening a return of the Eurozone debt crisis. The ECB may find itself having to cut rates aggressively in 2026, not because they won the inflation fight, but because they killed the patient trying to cure the disease. The danger for Europe isn't that prices rise too fast, but that the economy stops moving altogether. The United States faces the exact opposite risk. The American economy is a coiled spring, threatening an inflationary reacceleration. With the consumer still strong, fiscal spending still high, and the housing market structurally undersupplied, inflation could easily flare up again if the Fed eases too soon. We are already seeing signs of bottoming out in goods prices and commodities. If global growth picks up, the goods deflation that helped the U.S. in 2024 will end. This risk forces the Fed to keep rates higher for longer than the market wants. They are terrified of repeating the mistakes of the 1970s, when they cut rates too early and inflation roared back double. As long as the labor market remains tight, the floor under U.S. inflation remains high. The demand pressures haven't gone away, they've just been contained. The danger for America isn't stagnation, it's overheating. The beast isn't dead, it's just sleeping. So, what is the verdict of this great comparison in late 2025? Who had it worse? Who handled it better? Europe suffered a more traumatic, existential shock to its business model. America suffered a self-inflicted hangover from excessive stimulus. Today, Europe has lower headline inflation, but achieved it through economic pain and stagnation. America has slightly higher inflation, but achieved it while maintaining growth. For investors, this divergence is everything. It means the ECB will likely cut rates faster and deeper than the Fed in 2026. It points to a weaker euro ahead, and potentially continued outperformance of U.S. assets against European ones, as growth remains the deciding factor. The synchronized inflation spike is over. We are now in the era of the Great Divergence. The same storm hit both ships, but they are now sailing towards very different horizons. Thanks for watching this definitive breakdown. If you value deep dive economic analysis that respects your intelligence, subscribe and turn on notifications. Thanks you.